All right, why don't we get started? So thank you for joining. I'm Mark LaMonica. I look after the individual investor team for Morningstar here in Australia. And today we're going to talk about Morningstar ratings and how you can use them to help you evaluate investment opportunities. So before we get started on that, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're in New Zealand, you would like a copy of our FAP, you can go to our website, morningstar.com.au. And also the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. And you can listen to our podcast. We just had our 100th episode. Follow us on Instagram and come to our conference. So we'll be releasing tickets next week, along with at least a partial agenda, but we have a good day planned. If anyone wants a discounted ticket that's not on our wait list, send me an email. Mark LaMonica, mark.lamonica1, morningstar.com, and I will get you a discounted ticket either for in-person here in Sydney at the ICC or anywhere you are in the country or the world remotely. All right, so let's get started. How to evaluate investment using Morningstar ratings. So we take a little bit of a different approach today. So the first thing I'll do is I'll very quickly sort of walk through our equity ratings, then we'll go through a discounted cash flow model. And the purpose of that is not to spend too much time explaining what that is, but that is the way that analysts and most professional investors will go and analyze an investment opportunity. And we'll do that not because there's any expectation that you would do that at home, but I'll show you how the different Morningstar ratings fit into that. So when you're looking at them, you can understand what our analysts are trying to accomplish. But very quickly, first, we'll go through, and after then, we'll talk about fund and ETF ratings as well. First, we'll go through very quickly and point out some of the different ratings that you get. So one rating you get is, of course, our star rating. So our star rating represents where a share is when we compare the price and the fair value. So, of course, when we're evaluating investments, we are trying to concentrate on what something is worth, and then, of course, compare that to what it's actually trading for. And that is the way, of course, that you can discover undervalued investments. Now, the star rating is actually set using a couple of our different ratings. So I'll circle back to that one. One rating that's used is the fair value estimate. So the fair value estimate is how much an analyst, our analyst, believes that that share is worth. And the way that they come up with that is through this discounted cash flow. And that's what I'm going to show you guys in a second. So that's their calculation of what they believe a share is worth. Then the other rating that goes into the star rating is our uncertainty rating. So as you'll see, when we show this discounted cash flow model, they are, of course, predicting the future, because as investors, we do not care what's happened in the past. Now, the past can obviously be something useful to inform our view of the future, but it doesn't really matter. All that matters is what happens into the future. So if you're predicting the future, of course, that is something that's very, very difficult to do. So based on different conditions of the company, which we'll talk about, they may have high or low uncertainty, and there's a bunch of ratings in between, but higher or lower certainty about their estimates. And so the less certain our analysts are about the estimates, the higher that uncertainty rating is, and the bigger the margin of safety that we need before we invest in the share. So let's explain a couple of those concepts, because I know it can be a little bit complicated. So margin of safety is a term that was first coined by Ben Graham in Security Analysis, or The Intelligent Investor, basically his two books, one a textbook for his class at Columbia University, and then one a book that was supposed to be more approachable for the public. And what margin of safety refers to is exactly what I was talking about, that there is, even though it seems like there's precision in estimates of how much something is worth, of course, that precision is a little bit of an illusion because it is based on future events. And the future, of course, is unpredictable. So the margin of safety is what protects investors from things that are going to happen in the future that are unexpected. And all that margin of safety says is that if I'm going to go buy something that's worth $1, I'm not going to go buy it for 99 cents. I'm going to buy it for 50 cents, because then if it's not worth $1, if it's worth 75 cents per se, then I'll still be protected. And Warren Buffett, I think, has a really good way of describing this. And he's talking about a bridge. And he's talking about a bridge that has been engineered to support a truck that weighs a ton driving across it. Now, if you were driving a truck that was just short of a ton, you probably wouldn't be that confident. You probably want a margin of safety baked in there in case the engineer that built the bridge is wrong. Same thing when we're investing. So that's what a margin of safety is. We'll spend a little more time talking about it. All right, we've got the economic moat rating, which I talk about a lot on here, and that is an assessment of the competitive advantage and the sustainability of that competitive advantage that a company may have. And this is really important when we're looking at the future, because of course, as an analyst or as any investor that's looking at the future, we're trying to figure out, in this constant competition that you have between companies, who's going to be the winner, who's going to be the loser, what's going to be the impact on a company's financial results of this competition. So if you have a sustainable competitive advantage, it means you can fend off that competition. It means you could have a higher margin in the future. It means that you can have a higher return on funds that you invest in the company. So both very important, that we will get into in that next piece where we look at the discounted cash flow model. And then finally, capital allocation. So capital allocation is one of the most important jobs of a CEO and of the management of a company. And basically what it means is, what is that company going to do with funds that are either internally generated, so funds that are generated from just normal profits, funds that you access through capital markets. So that means if you're borrowing money through issuing more bonds or issuing more shares, you're raising money. What are you doing with that money? And are you doing a good job allocating it? Right? So there's a couple different things you can do. You can go buy another company. You could go and pay down debt. You could invest it in your own company. You could give it back to shareholders. You give it back through a dividend or a buyback. So that capital allocation is pretty important, right? Because managers that make poor decisions doing that, of course, it's your money, and that's really going to impact the future profitability of a company, right? Going out and buying a company for way too much money could impact the company that bought it for years and years and years and years. So capital allocation is important. So let's dive into our spreadsheet, which of course I have. Here we go. All right. So I'm doing a very, very simplistic look at a discounted cash flow model, but let's talk about what this means in general. So there is a concept in personal finance, investing, finance in general, that $1 today is worth more than $1 in the future. And of course, that makes sense, right? Because you have it today. And when we're thinking about dollars in the future, if they are worth less, that means we need to discount them back. And that's all a discounted cash flow model is. We are projecting out cash flows into the future, because once again, that's what's important to us. Anytime we buy a company, what's important to us is what profits that company makes in the future. So we're projecting those out. Then we're discounting them back to today. So that is what we are doing as analysts. So that's what analysts do. So I'm going to walk through that process, show you some of the different inputs. Once again, not because there's any expectation that you would go out and do this, but because this will help to explain what you're looking at when you're looking at Morningstar ratings, and of course, what our reports say. All right, so there's a couple different things that you need to look at. Number one, of course, when we're thinking about a company, and our analysts, their discounted cash flow models are, of course, a lot more complicated than this, but I have a very simplistic version. But if we're looking to evaluate a company, first thing we want to look at is sales. So you always hear people will say top line growth, hopefully growth if the company is doing well. The top line just refers to an income statement, what is literally on the top line. So an income statement, the top line is sales or revenue. So all that is how many goods or services you sold and for what price, and those are sales. So First thing we need to do to look at as analysts is we need to look at what are sales? What do we think sales are going to be in the future? And there's all sorts of different things that we need to look at, of course, when we're looking at sales. So we have to look at, of course, the industry that the company's operating in. What are the different product lines they have? Is this overall a growing market or a shrinking market? Really important. Then we have to look at the competitive balance as well. So whether it's a growing or shrinking market, are you maintaining the same market share? Or do you have, or do we expect you to have a reduced market share? So let's use a very simplistic example that if we can sit there and we can look at, and trust me, this is a simplistic example, we'll look at grocery stores in Australia, right? So if we look at that industry overall, it's relatively mature, which means that really the only growth that you're getting is population growth or pricing growth. Right. So all of a sudden, next year in Australia, Coles and Woolies and IGA and Aldi, they're not going to go out there and sell double the amount of groceries, right? Like the volume's not going to increase that much. It's going to stay relatively steady. It's going to grow a little bit with population growth. All right. So that's the first thing we can look at. The next thing, of course, we need to look at when we're looking at revenues, prices. So are prices going to go up significantly, or are prices going to go down, or are they going to stay the same? Because, of course, that's really important, right? If we're looking at volume, then we need to look at price. Now, this is, of course, where you need to start looking at competition. You need to start looking at, do these companies have the ability to raise prices? And for the most part, I know this sounds strange now, for the most part, no, right? So what has happened, of course, you had Coles and Woolies, and then all of a sudden you had IGA, you had Aldi coming in. And what this means is they don't have a lot of pricing power. Now, right now, prices are going up just because of inflation, but that is not pricing power. That is simply passing on higher input costs, which we'll get to in a second. But really important to look at that overall environment. If there's a lot of competition and there aren't really moats, right? So from a customer perspective, if Woolworths raise their prices by 20%, there's probably a Kohl's pretty close by, and I could go there. So if there aren't a lot of moats, then you don't have a lot of pricing power. And certainly the more competition you have, especially if you get low cost competition, means you also lose pricing power. So something to look at. All right, so we look at revenue. So once again, we do studies of the industry. We look at overall, what is that sort of total addressable market? How much is taken up? All sorts of stuff, and we project revenue out. Then what we want to look at, and once again, this is a very simplistic model. Then what we want to look at is margin. So I'm talking about free cash flow margin, but it doesn't really matter if we are looking at free cash flow margin or just earnings margin. What margin means is basically when you look at the top of one of those income statements, remember top line is revenue, then you go all the way to the bottom. The last line is earnings. So the margin, and there are lots of different margins, but the overall margins, what is the difference between that top line and the bottom line? And this, of course, really matters, right? Because it's important to project sales, but it's also really important to project how much the company is going to make, what comes out on the bottom. And once again, an income statement, if you go look at it, is very complicated. And there's lots of stuff on there. But at the end of the day, what's on there are all costs, right? Revenue on the top, then all sorts of different costs till we get to the bottom. There can be costs associated with the product, right? So if I am Kohl's and I'm selling carrots, well, how much is it going to cost me to go get carrots? So what's that? Literally the cost of goods sold that I have, that can fluctuate a lot. Then there's all the overhead and everything else. So I'm not just buying carrots. There's somebody who needs to get the carrots and transport them to a warehouse and transport them to the store. There's people that have to work in that particular Woolies. There's people that work in the corporate office of Woolies. There's all sorts of different expenses. So what I need to do is look at that as an analyst and figure out, okay, are these changing in any way, right? And so the big thing, of course, we see with inflation is, yes, they are changing. Right. So the first thing that we've seen and why food is getting more expensive is, okay, all of a sudden it costs more to go out and buy those carrots. It also costs more. We're seeing wages starting to rise, right? So it's going to cost more to employ all those people. We've seen fuel costs go up. So now it's going to cost more to drive that truck around to the warehouse and then out to the store. So you're seeing all these different cost pressures, and really what analysts need to do in this case is they have to figure out, okay, what is going to get passed on and what isn't, right? If I could pass on all my expenses, all my higher expenses that have increased, then my margin will stay the same. So are we seeing companies that have margin compression, margin expansion? And this is where we're really seeing kind of this battle across the supply chain, right? Because there's a couple different ways that this can happen, right? So if all the input costs, whether it's fertilizer, anything else, to grow those carrots go up, well, one solution is Kohl's or Woolies could go to that farmer and say, we're not paying you more, so you have to eat it. One solution is, okay, Kohl's and Woolies pays more and they eat it, right? They're going to sell them for the same. Another solution is they pass the whole thing on. And obviously it's never that clean, and you pay more, right? When you go buy carrots, you pay more. And it's never that clean, but this is really what we're trying to look at. What is that margin? And this is where Moat comes in. And this is where we have to understand when you see all this different stuff happening in the industry, when you see new entrants come in, trying to take market share at the top, when you see cost pressures, when you see competition around sort of that cost, what are the companies that are able to maintain that margin? Really, really important. Then the other thing, of course, we have to look at in this section between top and bottom are what are investments a company is going to make? And this is also where it's important to look at a moat or sustainable competitive advantage, right? So the investments that a company are going to make, we want to know what kind of return they earn. Right. So if Woolies decides to go out and build a bunch more stores, that's going to cost a lot of money. The question is, what is the return they get? And as I'm building this out into the future, if they build all these stores this year, are we going to start to see higher revenue going forward? And how much is that revenue going to be? And so companies that have moats or sustainable competitive advantages, of course, they invest that money in the company at a much higher rate of return. And so we'll see that as we build out this model. So it's really important to understand that the moat rating is not just a moat rating. It is key to trying to figure out the future and how competition is going to impact different companies. Because generally what the response is to competition from a company is I can do a couple different things. I can lose market share. I can try to maintain market share by lowering prices. If I don't have a moat, right, I can lower prices. Or I can try to make my product better. So it's not a great example for the carrots. I don't know how you make carrots better, but we can invest in our company and try to have a better product so people will buy ours and not go buy the others. So in this Kohl's and Woolies example, it could be, okay, well, I can redo all my stores, so they're a lot nicer. And people come shop at Woolies and not Kohl's because the stores are a lot nicer. But all of that costs money. And all of that, of course, is bad, right, from a company perspective, because that could all compress our margin. That's why we have to understand that competitive balance. All right. The next thing that we're going to do is, so we projected out revenue. We've got free cash flow. I'm using that margin. So free cash flow margin right there, right? So they maintain 11%. Going forward every year. And this is very simplistic. Once again, this is probably going to bounce around for companies, like margins change, there's puts and takes and everything else, but I'm keeping this easy. So this is 11% of that. So then we project this out into the future. Now, remember the whole adage we had at the beginning that $1 today is worth more than $1 in the future. So we need to discount that, right? So we can't just say that 5 years from now, this company will make $129,000. So that's great. We'll just add that to the value of the company. Well, we can't do that, right? So remember, we have to discount it. So what do we discount it by? Well, different people discount things by different things. What we discount by at Morningstar is a weighted average cost of capital. And so the weighted average cost of capital represents what does it cost for the company to go out there and source capital, source money from either borrowing it through like a bank or issuing bonds, or from raising it through equity capital. And I won't go through all the intricacies of how this is calculated, but very simply, this is our discount rate. And this discount rate, incidentally, is influenced by interest rates. So the higher interest rates are, the higher this discount rate is. And if the discount rate is higher, it means future cash flows are worth less. That's why shares are worth more in low interest rate environments. So again, if the flip it on its head, interest rates are low, that discount rate is low, it makes cash flows out in the future worth more. So just remember that. That's where that comes in. All right. So what we're doing is we're discounting all of these by this 10% and the years they're out there. So people that know Excel can see the formula. And we're adding them all up. So that's great. That's not quite the value of the company yet, because a company, I've only gone out 5 years. A company, of course, lasts in perpetuity, at least in theory, unless it's bought or goes bankrupt. So we need to make sure that we also value far out into the future. Now, we don't want to do a detailed model far out in the future because, of course, this is hard to do if you're talking about next year. Try and predict something that happens 15 years from now is impossible and not worth the effort, right? Just because there's no way we can actually do it. How are we supposed to know what the situation would be, in my stupid example, of Australian grocery stores 15 years from now, right? We really have no idea. So something really important to remember. So what an analyst will do is they will go out to a point in time, 5, maybe 10 years, where they have some confidence in what they're seeing. And then beyond that, what they'll do is they'll calculate something called the terminal value. And the terminal value is supposed to account for everything else that happens in the future, right? Because this company still does have a value. And what you basically need for a terminal value is you need a long-term growth rate. Now, I have a very steady growth rate of 5% here, but once again, this is not realistic. Really what you're looking at is, okay, I think this company will grow really fast next year, but then I see some headwinds and it'll probably slow down. So it's not a consistent rate. But for the long-term growth rate, we do want to have a consistent rate. And then what we can do is we can calculate free cash flow by using that rate in year 6, create a terminal value just by looking at the difference between that cost of capital and the growth rate. And then we discount it back to the present day. So basically what that allows us to do is add those two values together. The terminal value we calculated, the next 5 years that we calculated, or 10 years, or whatever the analyst is comfortable with, add those two things together. We have to be careful because, once again, we are trying to value the equity, trying to value shares here. So it means we don't own the debt, right? So we need to remove the debt that's sitting on the balance sheet. Then we have to add back in cash. We divide it by the number of shares outstanding, and we have a value per share. So that is the very simplistic way that our analysts will go in and evaluate a company. The one last thing I want to talk about is the uncertainty rating, because the uncertainty rating is obviously very important. So we touched on fair value, how we came up with that. Talked about Moat and why Moat is important when we're assessing the competitive environment that a company is operating in and what the impacts will be of that competition. But now I need to talk about uncertainty rating. So uncertainty rating, once again, is when our analysts are doing it, how certain are they that they are right? So basically looking at the range of outcomes that are possible for a company. The wider that range of outcomes, the less likely, the less accuracy there is and precision in that analyst calculation. Now, let's think about some of the factors that are going to influence this, because the factors will make sense, hopefully, after I say it. But there are lots of different companies, right? So I gave an example of a very mature industry with a relatively small amount of players in it, right? If we're talking about grocery stores in Australia, right? So it's an industry that we know isn't going to grow that fast. We know that there are established large players in the market. It's relatively easy, right, for us to predict in the near term what's going to happen, right? Kohl's is not going to double the amount of groceries they sell this year or next year, and the amount that they sell is not going to fall by half. Same thing for everything else, right? Like at best, we will see very minor and small market share gains for one of the competitors and very small growth potentially. So that is an industry where the uncertainty in order to predict things that are happening in the future is going to be lower. But then we could have another industry. We could have an industry that we're sitting there and looking at a biotech company that's trying to come up with a cure for an obscure disease where there has never really been treatment before. And maybe this company has one product, and this is it, right? They're one product for this obscure disease. It's out there. It's getting reviewed by the FDA in the US and the what's it called, the therapeutic, you guys know what I'm talking about, board in Australia to see if this medicine can actually come onto the market. So now there's a huge range of outcomes, right? So one of the ranges that this drug gets rejected. The drug gets rejected, the company that makes no money goes out of business. All right, so are Kohl's and Woolies going to go out of business next year? Very, very unlikely. Would this company with one drug that is awaiting regulatory approval go out of business? Yes, if it's not approved. Then maybe it is approved. All right, well, now this is a completely new drug for a completely new disease. We need to figure out what could sales possibly be. And we don't know, right? How effective is it? Like, is it going to be covered by different insurance plans? Does it get approved? There's all sorts of different outcomes. So the point is, in this situation, it is a lot more difficult to figure out a fair value. So there's a wider range of outcomes. And then you can couple that with other things. What kind of shape is the company in financially? So then we have to start worrying about, okay, even if this drug gets approved, do they have enough money to go out there and manufacture it and market it? They're in really precarious financial situation. I have to assess that. Will they be able to go out and raise money to do this, or will they go out of business? Versus a company that has a lot of money on their balance sheet, a company that has ready access to debt markets if they need to raise more money, company that could go out and raise money from shareholders, right? So very, very different situations. So all of this stuff can build uncertainty into a model, can build uncertainty into a model if it's a new industry that's still emerging. And we don't know how big it's going to get. We don't know who's going to win market share and who isn't going to win market share. So the point is that when we have that uncertainty, what we want to do is we want to bake it in to that star rating so that we can have wider margins of safety. So a low uncertainty rated share, we wouldn't need a big enough discount for a margin of safety. In that case, we might have a 20% discount. Whereas if you're, extreme in terms of the uncertainty, we might have a 75% discount before we would be comfortable as investors, we would be comfortable as Morningstar to say that you should go out there and invest in this, just because there's such a wide range of possibilities, and what you're trying to do is actually protect yourself. All right, so we've got a couple questions. Let's see what we have here. All right, so Frank says, is year one current year? So it kind of depends upon, and obviously, as you're setting up these models, unless you're sitting there, if we're looking at Australian financial years, unless you're sitting there on June 30th, you're always going to be sort of in that year. So once again, it's a very simplistic example, but I was looking at 1 year out in my example. So that's what I said for year one. But remember, most of the time you're going to be within a reporting period and trying to figure out, okay, where do I start this thing and where do I not? Okay, so Eric says, with interest rates bouncing around, how often does Morningstar adjust its company valuations with the changes in the weighted average cost of capital? Yeah, so there's two different inputs that go into that weighted average cost of capital. So the debt side of things, so when I talk about interest rates, I'll talk about how they actually impact it. On the debt side of things, it's observable in the market. So what that means is we want to figure out how much a company how much it costs for a company to go out there and borrow money. So on the debt side, you just look at bonds, right? As long as the company has debt, they don't have debt, it wouldn't go into that formula, right? Because they're just raising equity capital, which we'll get to in a second, but we can go out and see it. So what it means is it depends upon how those bonds are trading. So if interest rates go up, everything else should go up, right? All the other debt. So depending upon how speculative it is for the company, how not. But we're not sitting there updating this like every day, obviously, because the fair values would just bounce around all the time. So what they're doing is they're updating it at sort of set intervals when they revisit that fair value. But the other side of things is that equity cost of capital on there. So in that case, what we're doing is we're looking at set ratings based on uncertainty. So Morningstar basically has a range, and there's different ways that different people do this. Some people will use this thing called the capital asset pricing model to estimate that. We just sort of sit there and we say for a low uncertainty share, we're going to use this cost of capital. For a high uncertainty share, we're going to use this cost of capital for the equity side of things. And then we come up with that weighted average cost of capital, looking at how much debt and equity they have. Okay, so we've got a question from Frank. So Frank says, does Morningstar perform annual reviews looking back on previous valuation models and current valuations? And if yet, how does this compare with the analyst predictions? Okay, so what we can look at here, I will show you something. You can do it yourself. You don't even have to go back. Let me figure out how to share my screen again. Anyone who's been on these things before knows that this is not exactly my strong suit. I have too many windows open. It's my own fault. All right. So let's say we'll look at something fun. All right. So the one thing I would premise this for, we're going to look at Zip. The one thing I would preface this for, not premise it, preface this with is that remember that when we are calculating fair values, we are looking sort of what we think the intrinsic value of that company is. So it's not like always a point in time, obviously accurate approach. So when we go back and we look at the past, we need to remember this, right? That what you should see, hopefully, is over the long term, you should see that price to fair value and the price starting to converge. So this is Zip. And so what we're looking at here, so our history of Zip is we haven't covered it that long. But if you go back and look at this, what you can see is at a point in time, so November of 2020, we thought Zip was worth, you see the fair value on there, $4.50. And during that month, you can see the high, the low, et cetera, during that month. So in this case, it was a 2-star share. So we thought it was overvalued. And as we sort of progress in time, of course, it becomes even more overvalued. So now it's 1 star. All right. Then for people that watch this, Zip fell off a cliff. And you can see that as things changed, our fair value represented by this line, our fair value did come down. But in this case, the share fell straight through our fair value down to when it was trading for like nothing. And now, of course, it's shot up in fair value. So at this point, you know, if we look at August, which is obviously literally this month, you can see sort of where it's trading. It had this huge surge. It's up over $1 again, but we think it's worth $2, meaning that's our fair value. So that's really the way you can go back in and look at that. Yes, Eric has a good comment. I'll go back to show this. I like this too. Shawnee really likes the bull and bear. So yeah, it's another thing that I do think is kind of valuable, that, you know, anytime you're going out there and looking at a company, there are different opinions. And so especially if there's a pretty big gap between our fair value and what it's trading for, it means that our analysts think something that's pretty different from what the market thinks. And if you go onto this bulls say, bears say, you can see basically what people who think the share is going to do well say, and then people who do not think it's going to do well. So it is good to sort of sit there and think about, okay, like where do I fall in this argument? What do I actually believe? Because remember, everybody out there is trying to once again predict the future, right? And we've seen that at an overall market perspective lately, right? So, we go back, it was all doom and gloom back in May that, inflation's out of control. At the very least, central banks are going to knock all the global economies into recessions. And now everyone says, oh, well, inflation's still really high, but it's peaked. And so central banks will probably be able to engineer a soft landing, and they'll probably start cutting rates next year. And as different data points come out, people try to figure out what's going to happen. We don't know, right? So I could be standing here a year from now, and I'll tell you at that point if the central banks put global economies into a recession, and I'll tell you if inflation peaked and was brought under control. But obviously, none of us know, right? And so that's why it's really important to look at the different arguments that people have for why certain things are happening, right? So, and these are all generally pretty smart, educated people. And, I know even the inflation argument, I haven't watched it yet, but Graham Hand, who runs First Link, sent me a video that's this 10-minute video apparently about why inflation hasn't peaked. And then you have a bunch of people out there saying that instead we should worry about deflation, right? And so you have to come up with your own viewpoint. But I agree, Eric, that I think the bulls and bears say is useful because you can go in there and look at what those different arguments is. Okay, so does uncertainty also include company takeover, merging, and share buyback? So no, it does not. And the reason for that is, of course, we have no idea if a company is going to get taken over or not, or merge. And basically those mean the company ceases to exist if either of those two things happen. So we're really just looking at if this company is a going concern, what is going to happen. And then in terms of share buybacks, so the way share buybacks would fit in here is, number one, that would go into a capital allocation rating. So if we looked at past buyback, so buyback is simply when a company goes out there and acquires its own shares. And the reason that this is important, and the reason this is important into a model, because I sort of skipped over this part, that in this case, we valued this company at $1.2 million. And we had up here, we had shares outstanding. Because what we care about, of course, as investors is we care about per share profit, right? That's really, really important to us. So we're dividing this $1.2 million by 100,000 shares outstanding. So that's how we get the value per share. So that count of shares is really important. And we need to assess that, right? So that share count can change based on two different things. One thing is the company could issue more shares, and the company could issue more shares by doing just a capital raising that we saw a lot during COVID, where companies wanted more money. They thought, okay, we're going to lose potentially for, at the point, nobody knew how long, we're going to probably lose a bunch of revenue. We need to keep a bunch of money so we can continue operating until we get to the other side of COVID. So a lot of companies went out there and raised money. So they issued new shares. They sold more ownership stakes. Now, as an investor, that's bad for me, because if I'm a part owner of a company and the company decides that they're going to issue more ownership stakes, guess what? I own less, right? So during situations like COVID, maybe I'm totally fine with it. If the company's going and doing something good with that money, they're buying another company that I think is a good deal. If they are investing it in the company, and I think they're going to really grow profits in the future, I'm okay with that, right? Because that pie, even though I have a smaller piece of that pie, the pie is expanding. The other thing that can, of course, happen, well, the other way the shares outstanding increases is companies give them to employees. So companies that have, we particularly see this a lot in tech firms, companies that have compensation that is based on shares or options that turn into shares, they can use it to pay their employees. And that's a way that you slowly get diluted without some sort of giant announcement. But the other thing that can happen is that those shares outstanding can shrink. And they can shrink because the company goes out there and buys back those shares. And the reason they're doing that is they're doing that to increase the per share portion of the company that you own. They're shrinking that ownership stake. So you own more of the company, you have more of the profits, that price, that value per share changes, right? So if I change this, if they went back and bought back a quarter of their shares, now all of a sudden the company's worth $16.90 versus $12.67. So that's a lot better for me. So we'll judge that in the capital allocation rating, but we'll build that into our model. Because of course, it's really important for us to know what is that price per value per share. All right, let's get back to the PowerPoint. All right, I found it. Very strong day for me for switching over. So I'll quickly go through one other piece of our equity ratings is ESG. So ESG stands for environmental, social, and governance factors. So basically it's when we are looking at, we are assessing a company against those factors. So environmental is pretty easy. Are they, out there spewing carbon dioxide into the atmosphere? And obviously any other environmental impacts that you may have as a company. From sort of a social standpoint, like, are they adhering to societal norms around social factors? So have they decided that they are not hiring any women or any minorities? So that's obviously going to rank them pretty low, and in real world, what we're looking at is, upper management, diversity and board diversity, things like that, certainly pay, equity. So, and then governance is, if we look at the board, number one is the board representative of shareholders, are they all insiders? Is there something screwy around the voting rights on the shares that we see a lot, right? That maybe the founder of the company, that he or she only controls 20% of it, but has worked out different share classes, so they have 80% of the votes. And they can, of course, control the company, things like that. So basically what you'll see, and this is on a sustainability tab on any company that you look up, is you'll see our assessment. So first of all, we have an ESG risk rating assessment. And what we're looking at here is, of course, we are not trying to push any sort of values on you, but what we're trying to say is this stuff is a risk factor that's going to influence the value of this company going forward. Right. So, if they find out, and I think this came out a couple of years or something, but they find out that all Nike shoes are being made by 11-year-olds in Bangladesh, it's not great for the company. Right. And that is going to impact the value of the company. Now, you can decide on your own whether you think it's appropriate for 11-year-olds to make shoes all day in some factory. That's your own choice. But you have to realize that overall, given societal norms, that's not going to be a good thing for the company. So what we're doing is just incorporating that into the ESG risk rating, right? And then you can see, and this is actually BHP right here. Should have left the name up there, but you can see, okay, what is of all the different things that could be controversial about what a company is doing, what is it? So operations. So yeah, it's a little bit controversial to go out there, whether it should be or shouldn't be, to go out there and mine a bunch of stuff, especially when you have coal operations like BHP. And then, yeah, what are the three biggest issues? There you go. Not surprising, sort of given what kind of business they're in, but those are the equity ratings that we have around sustainability. All right, moving on to fund and ETF rating. So I'll go through these rather quickly since we only have 15 minutes left. Our analysts also go out there and rate funds and ETFs. And basically what they're rated on overall is something called our medalist ratings. So a medalist rating is gold, silver, bronze, neutral, negative. So basically gold, silver, bronze, obviously in varying degrees of confidence, means that we believe that this fund or ETF will outperform its index over a full market cycle, so 3 years. Now, remember what outperformance index means. Outperforming your index could mean that the index goes down 70% and you go down 65%. And that is a great victory, right? If you're an active fund manager. but that does not mean it's going to go up. So it's very important that people are not confused that gold, silver, and bronze does not mean that we think this investment will go up. We are not assessing that. We are assessing it against its category. So pretty important. And what we do is we rate it on 3 different criteria. So we look at process, we look at people, and we look at parent. Now, another important thing, as you can see, Vanguard Australian Shares, is that if we are rating a passive company, a passive investment is obviously not going to outperform its index. It's supposed to replicate its index. What we're looking at there is we're looking at assessing the index and assessing their ability to do that, to match that index. So something important to remember. So what are we looking at? Process. So process is what is the investment process. So of course, if we're looking at an actively managed fund, we're going to go in there and look at the people that are doing it, right? What is the process that they go through in order to select securities? People, who are these people? Do they have experience? Do they have a good track record? Our analysts go out and meet with all the fund managers, something that's obviously very difficult to do as an individual, but our analysts do have access to them. Assess the people in the process through that. The parent, so what is the company that is issuing this fund or ETF? What is their reputation? Does the company have a track record? They're doing all the things that are really important, right? Retaining talent, investing in infrastructure and risk and controls and everything else that you would want as an investor. And those 3 ratings go into that rating right there. So those are our fund and ETF ratings. They're rated exactly the same team, same process, and they're looking at these factors. We also have sustainability ratings on funds and ETFs. And basically what we're looking at here is for a fund and ETF, we are doing a look through to the securities that are in there, and we're rolling that up. So ESG has obviously become this enormous thing in investing, which lots of people have lots of opinions about. Because it has gained so much in popularity, there's obviously a lot of incentive for all funds and ETFs to go out there and say that, hey, we are looking at ESG. We are holding the investments that we make to ESG standards, and we're basically going through and checking them on that. So in this case, this is an index fund. It's an index fund that invests in Australian securities. So you're getting a lot of minors. So not going to score that well from an ESG criteria, but we're doing a look through and looking at the underlying investments and saying, okay, is this a situation where this fund is something that is investing sustainably according to us? Right. So that is only according to us. All right. Well, that did go very quickly, a lot quicker than I thought it would. So any questions that anyone might have, now is the time to ask them. And if not, we will go away until Thursday. All right. Well, awesome. If anyone does have any questions, you can email me at mark.lamonica1@morningstar.com. Also send me an email if you would like a discounted ticket. Just like you're on the wait list for our conference on October 13th, you can come to the conference and say hi to me and other people. So anyway, thank you guys very much.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.